I'm going to welcome to the stage Nate Erickson, who's going to be moderating today's discussion. Nate's a vice president at Transwestern. He's been working in the Twin Cities market for over 11 years now, focusing on companies in manufacturing and life science fields, industrial. He's also a co-chair of our education committee and on NIOP's board of directors. So without further ado, let's welcome Nate, and we got a good panel today.
Good morning, everyone. As Anders mentioned, I'm an industrial broker with Transwestern in Minneapolis. It's pretty exciting to be back in the same room with everyone. I know it's been, probably 7 or 8 months or so since we've actually been in the same room, and it's really a joy to kind of see all of our normal people. We're such a social industry that it's not having that is kind of a downer. So this program is supposed to be kind of a litmus test to see how interested people are to come in and go to events in person. So I think we have probably about 70 people here, which is really a max out for the room given the CDC guidelines. So I think we have probably another 50 or so online. So really appreciate you guys coming out. And thanks for Golden Valley Country Club for adhering to all the CDC guidelines. We'll try not to make this thing a super spreader. So I'll be moderating the panel here today. We'll try to wrangle these cowboys for 60 to 90 minutes or so and make sure they stay on track. It is debate season, so with that in mind, each of the respective panelists and their teams all accepted some ground rules, or at least one ground rule. If any of them say Amazon effect, they got to take a shot of whiskey. So we'll keep you guys honest on that one. So no, honestly, the Department of Commerce didn't like that, so we actually had to pull that from the outline. We'll have 6 segments. We'll be starting with the economy and just kind of overall sentiment. Development, construction, leasing, deal terms, overall outlook, and then we'll have a little Q&A time at the end in the event that you have questions here. I think there's an option online for people to submit questions. So with that, resilience. Resilience is the capacity to recover quickly from difficulties. What you'll hear from the panel today is how the industrial market has done just that. It's been a bumpy road, 2020, but industrial has weathered the storm, and I think it'll be coming out the strongest on the other end. So let's start with, I've got a couple slides here, just probably 8 or 9, that will provide some context to those of you that don't spend your normal life in the industrial world. So to give you some context, we've got about, Minneapolis is the 16th largest MSA in the country. We've got about 3,000 buildings total, both multi-tenant and single-tenant properties, the total of about 330 million square feet. We've got about 1.6 million square feet that's currently under construction. On a good year, it's probably about 2.5 million. On a bad year, maybe it's 0, or in the last 10 years, probably a down year is 1.5, 1.6. So I guess the story here is, we still are seeing some new development, and that ranges from anywhere from 130,000 square foot spec development in Eden Prairie in the Golden Triangle, 156,000 square foot build-to-suit in Brooklyn Park with Curator Water and Rhine Companies, and 428,000 square foot build-to-suit with Up North Plastics in Cottage Grove, among others. Our market is really known for a somewhat conservative approach, even though we're a pretty blue state. We're, our developers don't get too far out, over their skis, and keeping up with supply and demand and making sure those stay in check has been kind of a characteristic of our market. So here's a little overview of the vacancy. Have about 6% vacancy across the board, with a couple submarkets leading the charge. Minneapolis North, which incorporates Roseville, New Brighton, 35W Corridor, and Blaine. That's running at about 5.5% vacant, and 5.8% around the airport, which incorporates Burnsville, parts of Eagan, and East Bloomington. This is a great, is this showing up correctly on the screen? It's a little weird. This is a great graphic. This shows essentially the total deals that got done in the last 12 months as a percentage of total square footage. So, and we have them divided by the industries that lease space or purchase space. So you got manufacturing, retail, transportation, and distribution. I think, something that we're going to be talking about here today is retail making up 19% of the industrial deals in the last 12 months. That's pretty impressive, especially because we're talking about warehouse space. So that's going to be a key theme here today. Historical absorption. Wow, this is really not showing up very well. Anyway, it really ranges between 1.5 million square feet of positive absorption and 1.5 million square feet of negative absorption. It's been a great ride the last 5 years. Pretty much every single year has been positive absorption with the exception of a couple quarters. Vacancy, in the early part of 2012, we're climbing out of the depths of the recession, and we're at about 12.5% vacant. And it's really been a consistent compression of vacancy rates with the exception of 2014, and that was really due to a lot of new development, spec development coming online. But outside of that, it's been a great ride the last 8 years. Asking rates, it's always been kind of a running joke in the Twin Cities. I think the great Jimmy DiPietro said when I first got in the business that the Twin Cities has always been an 8 and 4 market or 850, 450 market, and that's largely been true and until the last couple of years. And I think Ryan Bartley with Link or Peter Mork with Capital Partners is probably going to have a bone to pick with this, and they're probably going to want to be driving these rates up a little bit more. And lastly, this is just my opinion, five major factors of industrial demand. Really, essential businesses. Most of the occupiers within industrial properties were considered essential businesses and didn't suffer government-mandated shutdowns. Zoom calls don't build America. A warehouse and manufacturing facility is essential to these businesses and can't be replaced with remote work. Lack of density. We see about 25% of the personnel density that office and retail properties experience, making it easier to comply with CDC safety guidelines and not hinder productivity. The supply chain disruptions, COVID-19, and trade tariffs on China have spurred companies to rethink where they're sourcing materials and manufacturing their products, onshoring American manufacturing jobs, driving space demand. And lastly, e-commerce. The drumbeat of e-commerce can be heard louder than ever. Even late adopters like myself are getting wrapped up in the ease and the convenience of using online shopping. So I've said it before, retail's loss is industrial's gain. So with that, let's turn it over to our panel. We'll start with Ryan Bartley. Ryan is Senior Vice President with Link Industrial Properties and oversees the Twin Cities portfolio of nearly 14 million square feet. He has also worked in asset management and investments with CSM Corporation. Prior to making the transition to the principal side, Ryan worked as an industrial broker. Mark Kolsrud. Mark is a Senior Vice President with Colliers International, focusing on industrial, office, medical office, and single-tenant investment sales. Mark has been in the business for over 30 years, and over the course of his career, he represented nearly every major owner in the Minneapolis market, either through investment sales or during his time in the leasing world. He's one of the top brokers in the Twin Cities, transacting more than $3.5 billion in real estate sales. Brent Masica. Brent is an executive director in the industrial brokerage department at Cushman and Wakefield. Brent works on one of the leading brokerage teams in the market, representing both owners and occupiers of industrial real estate. He's been in the business for about 14 years and a 7-time recipient of Cushman's Offshore Club, recognizing their top producing brokers. And lastly, Peter Mork. Peter is the founding principal of Capital Partners, the second largest owner and operator of industrial real estate in the Twin Cities with over 8 million square feet. Peter has over 30 years of experience, first as a leasing broker and as a principal starting in 2000 with the founding of Capital Partners. Mork, he's really done it right. He's found a way to work himself out of a brokerage job. So, congrats.
It's a good gig.
All right, let's get started. So, give me a word. Give me one word to describe the industrial market these days.
Healthy.
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 Stable.
Stable.
Evolving, I think.
Okay.
I would say corporate. Excuse me.
Why is that?
Oh my gosh. Every RFP it feels like that we get has a national broker. You've got to run it through, multiple chains of approvals. So I'd say on both sides. You got the tenant side, who you got national users with national brokers, and it just feels like the bigger companies are getting bigger. So that's from the tenant side. And then on the landlord side, you've got larger corporate landlords coming to town. There's fewer local developers and owners, so there's more asset managers, there's more advisors, there's more calls, there's more spreadsheets. You got the evolution of VTS, which is a prospect report that people are using. So it just feels like everything is a little bit more corporate.
Sure.
Yeah.
Is that good?
I don't know if it's, well, from the landlord side, yes, you're getting better credit tenants, I think.
But you got more. If you have a more educated landlord.
You have
than
a more
had
educated-
15 years ago, right?
No question.
Right.
No question. And a more educated, more sophisticated tenant.
Sure.
For sure.
Sorry you have to use the Excel spreadsheet a little more than you use.
But clearly, our level, industrial is a professional organization. I mean, it has gone, it's still got the cowboys in it, but it's really moved into being a solid professional organization. Sure. And then with all the institutional capital that's coming into industrial over the last 10 years especially, it's increased the game. So
Right.
you better have your A game on.
Yeah.
And it's an efficient market too. It's like the stock market. You're not educating, Brent. You're not educating your owners.
Yep.
They already know the market.
No question.
Right? They know where the rate should be. They know the competitive set, and so it makes it, I think, better for everyone. It's just a stronger market, and gives us the ability to push rents.
Yeah, here we go. Yeah.
Here we are ready.
I heard Link is cutting rents. They're doing 3-year deals, giving all sorts of rent concessions.
Well, we're certainly not the leader in concessions, but I have to keep up with Morky when he's trying to give all this gross free rent to everyone.
Oh yeah,
So.
I love giving away gross free rent. Yeah, that's for sure.
Yeah. So how are you guys evolving, to use Bartley's word, with the current market, with COVID, with tenants kind of just trying to hold on for dear life, trying to survive? I mean, how are you guys evolving? How are you handling this current pandemic?
Well, I think this pandemic has been, it's obviously been terrible, but it's created pause, and it's allowed for tenants and owners to really evaluate, what's moving forward. And I think long term, we're really going to start seeing groups come out of this positively. We're evaluating the supply chains and the processes, and so groups that are actively pursuing opportunities, whether it's on the landlord or the tenant side, have been thoughtful about their approach and what they need. And so I think Minneapolis is growing we're getting stronger credit groups in town on both sides, the landlord and the tenant side. Sure. So I think we're evolving in that side, that it's just a more sophisticated market.
Sure.
Yeah, I would agree. I think, not to get too political, obviously Trump thinks it's a V-shaped recovery. Biden thinks it's a K-shaped recovery. And I would tend to lean more towards what Biden is saying, is that it's K-shaped. I say it's a king-shaped recovery, because the bigger are getting bigger, and the smaller mom and pop organizations, I don't think they're going down, but I think they're clearly pausing. I mean, we've gotten more requests for month-to-month deals, year-to-year deals, just short-term deals, because the smaller companies they're paralyzed. I mean, the larger companies, they've got the cash, they've got the foresight, they can figure things out, but the smaller guys, the local operators, they don't know what to do. They're waiting to the last second. They need a bigger sample size. They're trying to understand everything, how this is all going to impact them, and so they're saying, let's go month-to-month, or let's go year-to-year. Let's take a little overflow space. I think they want to grow, but I think they're scared to grow. So we're seeing that, and then because of that, I think we're seeing a lot of 3PLs out there. Those smaller guys are saying, I don't want to go take the risk. I'm going to go outsource it to a 3PL And that way I can sign a 1-year contract with them or whatever it might be, and then if something goes bad, they can bring that in-house. And the 3PLs are going out there and signing the leases. So it's interesting in that regard.
Yeah, it seems like with the requirements coming out, I've really been surprised the last 6 months with how many 80, 100,000 square foot tenants that have been coming out with requirements. It's been somewhat of a counterintuitive. I guess initially what I was thinking is, wow, I mean, there's definitely companies out there that are really rocking and rolling. They're taking down space, and it didn't seem like they really hit a speed bump at all.
I'd rather have a 100,000 square foot vacancy than a 20,000 square foot vacancy to lease right now. There's more action on the larger side than the smaller side.
And you brought. Oh, sorry. Go ahead, Peter.
I want to say, that's kind of a problem today because we don't have the new development occurring. We don't have a lot of spec construction. We got 6% vacancy rate. I mean, that's crazy. We haven't had that. I've been doing this 35 years. 6% vacancy rate. We would see so much spec construction going on. Gary Holmes, John Allen, everyone would be going nuts. But we don't have those developers anymore. We've got Skanal, who's aggressive. We got UP, who does a nice job. We got Opus that's selective. And then
Duke is selective.
Duke is selective. First Industrial is not doing much. So you've got this pent-up demand in the 50,000 square feet and up. They just don't have a lot of options. I mean, the developers in this market are really in the catbird seat. They're sitting fat and sassy, and they've got the land, and they don't want to sell the land. They want to do spec new leasing. So if you have a requirement and you want to own, you want to go find a piece of land and own and buy the land, it's going to be very difficult.
Yeah.
What's interesting is across the country, we're seeing the development costs going up so exponentially in the cost of land, and my business partner in California is talking about developable land for $75 a foot. I don't know how, my mind that's crazy. That's like, beyond what I could ever imagine. Locally, I think United Properties and the groups that are here locally that are intelligent about what their markets are going to start to be able to pay more of what they, as a percentage for that land than they had before. And so it's going to be interesting to see this land cost go from $7 to $8 and $9 and $10 in Minneapolis. Those are numbers that hadn't been touched. But with the capital, and we're going to talk about it later, I know, with the capital coming in behind it, and it's safe capital where it's really, you can imagine that cap rate is going to be there. If you start the project today, the buyer's still going to be there by the time you execute the leases, and with the big leases that Brent's talking about, it should happen. So that's the part where I think that we're going to have some stability in that particular product type. But it's going to be they're going to be smart about it. They're going to have to think about it. They're going to have to,
But you're saying it's got to be bulk.
Well, I think it's interesting. So Minneapolis has always really enjoyed this office warehouse market as well, where across the country, we don't see that as often. So other markets that I've worked in, that's not as popular. Here in Minneapolis, tons of doors, docks, and drive-ins in the back, 24-foot clear is a reasonable building. You're going to get a low cap rate for that building. Yeah. Where in other markets, that's an office showroom building, practically what they would contemplate. Sure. And so that's one of the differences that Minneapolis, when I pick up someone from the airport and I say, hey, let me tell you about Minneapolis as I do the loop, right? And you got to look at the businesses that really created Minneapolis, and that's the agri-science, health science, and have a lot of technology. Our employees are well-trained and thoughtful, and we have a lot of technology in the industry which doesn't need the bulk as much. Now, we need bulk buildings in a mix of a portfolio, and so that's why you'll see in Peter and Ryan's portfolios, they have a mix of that. Sure. And that's where it's, they can defend the market. So the flex is something that also works in our market.
But to get the development active, the rents need to be pushed up. So you spoke to Gary and that group of individuals developing, and they were buying land at $2 or $3, and then they were able, and construction costs were lower. Yeah. So they were able to do those $850, rents, or $450, $850. Yeah. Now, if land is $650 a foot and construction costs are more, we need to rise our rents up to be able to support those.
I don't think we're quite at $650 rent or $650 land prices. I mean, Opus has paid a couple big prices and they made it work, but across the board,
WPT.
Yeah, but as a whole, I don't think we're ready to say everything's $650.
I agree, except that if you add in soil costs and all the other parts to that, that's where the number gets up, right? So the number I'm referring to is that's the all-in number. By the time you get there, It's pretty expensive. And then if you do a 4-to-1 coverage on that, they're $40 sometimes underneath the building for their land cost. And so suddenly it's like $40. When I started in the business at Robert Boblet, I mean, I remember Bob Boblet talking, if you can't buy a building for $20, just keep going. And, now how many years later, right? So.
Sure.
Well, that was the whole thing. I mean, spec development, in the last cycle, 2014, 15, you had to be $15 a foot under building or less to make it work. And now we're saying we can push that up a little bit. And I think we can push it up a little bit because rents are obviously going up. And I think rents are going up because the tenants are getting larger and more sophisticated, and they need a more sophisticated facility. You look at deals like Opus is doing in Maple Grove, like that AbleCon deal. When you get rents that are, $7 production rents, you can pay a little more for rent or for land.
Brent, can I hear you say it's a landlord's market? Can you say that?
It's an equal market right now.
Oh, come on. 6% vacancy.
I kind of want to go back to your comment, Brent, about maybe just touch a little bit on politics. We are in a presidential election. There are a couple things like capital gains tax and 1031 that are being, they're in the crosshairs. What effect will that have on the market, and how will landlords react to that?
I can talk a little bit on the user sales market, and then you guys can talk about more on the capital market investment sales. We've got a building up in Maple Grove that we're selling right now. It's just a small $2 million building. We got an offer on it from a group that has a 1031 exchange. Seller didn't counter a dollar, didn't want to get into a back and forth because he wants to close this year, thinking capital gains are going to go up. And the buyer just came up and paid a big price because they thought their 1031 might go away next year too. So we've got a couple of those examples where buyers and sellers are fearful for what could happen. So they're trying to get deals closed before the end of the year.
Sure.
Yeah.
Bart, Mork, you guys seen any changes in strategy with those two, I guess, those two policies in mind, or perhaps I think the Fed just announced that they were going to keep rates, somewhat probably near zero through 2023. I mean, that's got to affect how you guys are looking at the market.
Go ahead. Yeah, I can talk about that. I'd like to get Coles' thought on this. The Fed keeping the rates 0 to 2023, and you've got all this money, all this institutional money around the world that now all of a sudden just wants to focus on industrial, right? They don't want to go to office for obvious reasons. Multifamilies got concerns.
No retail, yeah.
Hotels, no way. So now all this money wants to funnel down to industrial. So there's a big portfolio coming out in the Twin Cities. We're going to see a lot of new players that want to run at it because they have to deploy the capital. But interest rates going down is going to create more, it's going to make the building worth more money. But the building hasn't created any value. All that's done is interest rates have created more value for the building. And there's a lot more opportunity for the interest rates to go up in not the near future, but 5-7 years from now, which is going to deflate the value of the building. And it's nothing that the building did. The building should be valued on the NOI of the building, the creditworthiness of the tenants, and the terms and the length of the lease. Then you got this variable interest rates. Interest rates drops, and everyone says, my building's worth more. Well, not really. Interest rates drop, which created your building to be artificially worth more. Yeah. And so in the future, interest rates go up. You're going to have your clients going, what do you mean it's not a 4.5?
Well, it is interesting because, in the analysis that an investor will do, it contemplates when it sells, and you have to just guess at what the cap rate will be at the end of a hold period, and every owner has a different hold period, right? Because no one's buying a building for the cap rate. I mean, that is the measurement that we use when we compare one sale to another. But the investor is doing an internal rate of return. And so they're figuring what they're going to make during a certain period of time. They're going to figure out their capital, and they're going to figure out what they're going to sell it for at what number in the future. And so,
but if interest rates go up,
exactly. If interest rates go up,
that's a big problem.
We know that that's going to have an effect on cap rate. And so in the 10th year, there is this potential. And so that's kind of one of the things that I think that we can look at its occupancy. Our 6% vacancy rate, that's falling, right? I mean, we know that. Without, as we were discussing, there's less and less space coming available. And then the owners of these buildings are more efficient and better at it, keeping them full and doing everything you can. And the tenants in it are the industries that are sustainable in this time, right? Mm-hmm. So lots of money you're chasing into these things, but it'll be interesting to see what interest rates do in the long term. Short term, it's free money, right? And so it's accretive to a lot of these investors, these math. So.
Sure. I think that brings up, kind of the rise of institutional money in Minnesota. I think we talked a little bit about it before, but for a long time, Minneapolis has always been kind of the local owner, developer, local investor that held real estate here. But now we're seeing groups like Blackstone and Prologis and I guess among others. But maybe talk a little bit about that. Are institutional owners seeing Minneapolis as a long-term hold, or are they kind of doing a pump and dump? Just hold it for 5 years and then get out of here.
Well, it's interesting. So when other institutional groups have watched what Blackstone has done across the country, and they've seen that, and the ability for Blackstone to raise capital so dynamically, and so other groups, there's probably 5 or 6 other like that are right there. And so now Prologis is selling the portfolio that they purchased in Minneapolis from Liberty, right? And they always had, when I sold all those buildings to A&B back in the day, and then it became Prologis, it was clear that they didn't want to be in Minneapolis, and so they exited, and now that's what they're doing. And they're exiting in a wise way and a smart time, because all this money is coming in and they want to be here in Minneapolis. And so for all that reason, they've decided it's not for them, but there's 5 other big groups and a lot of others. So one of the things that Minneapolis has is also a lot of operators like Peter that are really good operators with the ability to take some of this big institutional money and make big buys and then operate it from a local level. And so I think that we're going to see really an interesting cycle this next couple of years where one institution sells to another, but I think the operator money is also going to be really part of it. So, but it is, do you want me to talk about the differences in some of the capital market stuff right now? Is that a good segue into that? Okay.
I have a couple questions that will dive into that a little bit. But
here, so.
2 of our largest local owners, Industrial Equities and CSM, are now, I'd say, largely out of the industrial world. Some of them, I guess Industrial Equities still does have a couple land sites, and they are still putting up a couple buildings. But for the most part, they are out of the industrial world. The 2 headliner deals last year were CSM selling and Industrial Equity selling. And we've got 2 guys here that were involved in that. I'm just wondering, what was it like being in the room with Gary Holmes doing that deal?
Well, it comes on the heels of doing the deal with Industrial Equities and John Allen, and as your comment is mostly sold out, but John still has 1 million feet of industrial locally as after he's sold such a large portfolio, of course. So, and John said to me the other day, we honored him as a Lifetime Achievement Award just recently, where Gary Holmes actually gave him the Lifetime Achievement Award. Special time. Yeah. And so John's like, well, I'm a shark, and sharks have to be constantly swimming to have oxygen in their lungs. They got to keep going, So that's like the perfect, John Allen quote, right? Yeah. Everyone that knows John loves that. And so Gary is probably one of the smartest guys I've ever met. And he was watching John evaluate the market, and we worked for only 21 years to find the right buyer for John Allen's portfolio. And so after that quick little exercise, Bartz and I started talking in 2018 about, well, this is what's going on, and here are the different capital groups that would be interested in these larger deals. And, I had a relationship with all of them. We're talking about which one would make the most sense for Gary as well. And some of these owners are looking at where capital gains are, and everyone knows, regardless who wins the election, capital gains will never be as low as they are now. So some of these groups are saying, if there's ever a time to pay some taxes, now is a good time to do that. And then I guess in January, we can kind of jump into this if you want. And then so in January, we were on a ski trip that actually some of the top people at Blackstone were on as well. And so we had the breakfast in January of 19 after having lots of discussions during all of 2018. And Ryan went back and said, I think these Blackstone people and these Link people are really legit, right? So I'll let you tell what those conversations were like as well. So.
Yeah, and so Blackstone was not a secret to Gary. I mean, he sold a $100 million hotel portfolio to him several years before, so he had built a relationship with them. and trusted that relationship. That process went really well. So in January, when Mark and I met with those folks and I brought that back, Gary had already understood, how they operate. But it was interesting that he wanted to understand how John Allen's portfolio went and how that process went. He was really more focused on the process than anything about dollars or anything at first. And he wanted to make sure that he had the right group. He did not want to mass market it. He wanted to talk to one group and make sure that he was getting the right price for it. And so we did a lot of just deep dive into the portfolio, understanding from a high level and down into the nitty gritty of it for several months. And in around April is the time that I think the CSM felt comfortable and had all of their ducks in a row to have a dialogue around it. And from there, we gave them just a limited amount of information, and they came back with something that really sparked an interest in CSM's attempt to potentially sell a big piece of it. And and the rest is history. A year later, it happens.
Well, it's interesting too. Ryan's not telling this part, and so let me ask us a question. So,
A lot of parts.
so yeah, a lot of parts. Well, a lot of stuff we won't cover, right? A lot of fun. But when was your daughter born?
The 24th of April.
Yeah, in the morning, right?
Yeah, at 6 a.m., yeah.
And that was the day we had the big meeting between Gary. So Gary is like, that's the day, and it kind of lined up. And Bart and I were like talking. He's like, this could really. There could be a conflict here with having a baby. So he literally has a child in the morning, and we have the big meeting that afternoon. So
Hammering out the last details, or
the start of it, yeah, the first
the
details. So after that, it was so easy. It was really nothing. And then there's this little thing that a little bug popped up and called COVID, and then but they closed on April 9th amongst all of what was going on. So
Yeah.
yeah.
Is his daughter's name Gary?
Gary. Ron Shoulder asked him if Bart's daughter was named. No.
No, her name is Izzy, not Gary. I have a dog named Gary, though.
You kick it?
And you love your dog.
Oh, man.
Oh, God. Good story.
That is a great story. That's it was the largest, was it industrial deal in Minnesota history, or the largest real estate transaction?
The largest industrial investment sale ever was the industrial equities transaction that we did in 2019. The largest overall never investment deal ever, all product types, was the CSM.
Okay. Couple nice feathers in the
And I
hat
was
there.
told, Bart told me not to ever, I'm not supposed to say that I'm so blessed to be able to part of it, because he said the last time we talked
Where's the
about
whiskey?
it, I said that, I said I'm blessed 7 times, I think, but I really was fortunate. How's that? Is that a better way to say it? Yeah, all right.
Blessed is great.
Blessed is good. All right.
And Link is done buying now, I understand, right? It's,
I would not say that.
well, in this market, hopefully.
We'll see.
They're taking a run at Prologis.
I can tell you that they are not done. They are definitely not done, and so it's Ryan's job's only growing.
Here's a question for you guys. So with the all these institutional owners used to paying super low cap rates on the coast, you think we'll ever see a sub 5 cap in the Twin Cities?
Oh, for sure.
Yes.
Yep.
And where are they at today, and when do you think we'll probably
So
see that?
I would say it's for one building or a couple, 3 buildings that are perfect, we're a 5 cap. And in some cases, it's all about rent growth. So remember, that's what's happening in these coastal markets and all these core markets. If they see the rent growth, the cap rate falls. So if they believe that there's opportunity within that, it could be whatever cap rate, because it's the internal rate of return that they use in their analysis. And so that's where this, what's the cap rate, what's the cap rate? Well, okay, but what's the returns? Where is it going? And so as we see the vacancy rate for the best industrial going down, Northern Stacks and other projects like that, it's going to be really hard to replicate that in other places in our city. And so we're going to see smaller buildings that are filling in some of these locations. We're going to see larger knockdown sites and other things, and in our transportation, as it increases to other markets. Minneapolis doesn't have the high highs and doesn't have the low lows. And so I'm not trying to create the spin that our market should be that 4-something cap rate, because it's nice if it's just steady Eddie. That's the Minnesotan way, right?
Right.
So, yeah.
But, Mark, to that point, I mean, we're going to see that in a portfolio sale below 5 cap, right?
Yep.
The individual owner that owns 1 or 2 or 3 industrial buildings is going to have a difficult time achieving that because they're not going to be able to attract the institutional buyer. And where is that threshold where they'll come in?
Deal size, you mean?
Yeah, deal size to move the cap rate down.
Well, it's interesting, the deal size, and Ryan would have to talk about this too within length, but I would tell you that a lot of these big groups, by way of their operator or by way of, whatever it is, they're shrinking what their deal size is. And so
Was that 10 million?
we'll see $10 million deals that actually have the potential of being the lowest cap rates because it might be a $4 rent where it should be $5.50 or something, and they just have to wait a year or two to get to that. And so we're going to see,
If it's a strategic purchase.
strategic.
Yeah.
Yep.
Not just a one-off $10 million build.
No. Yep. So, but I mean, Ryan's busy thinking about where they're going with their rents and what they're doing and what to do to design them to achieve that premium rent. And so this is not this won't be part-timer kind of loosey-goosey time. There's a pro market right now.
So we get rent growth going at 3% on all these pro formas, right?
Yep.
And on these new buildings where rent is already high, right? We're already talking about rents, 12 and $5.50 or something like that.
Yeah.
12 and 6, whatever parts.
Not enough.
I mean, how much can they believe, these investors, that rent is just going to grow at 3% for the next 10 years for that lease, and then when they renew, it's going to keep going at 3%. And all of a sudden, that warehouse rate is 8.25%, and everyone's just trying to believe that it's going to be 8.25%, and it's not going to reset 10 years from now?
Yeah, it's tough. It's tough to think that would be a reality, especially when you look at that historical
That's
rates.
what I'm saying.
The
And
last
us as
8 years
brokers,
is
and we get
pretty much
higher,
like
and all of a sudden you got to achieve those rents. It's like, well, did we think about this 10 years ago when we didn't, 3% on 6.25% rents? All of a sudden you're at $8.
Well, and the other thing, so I'm not going to disagree with you. I think that you're right, because I think that sometimes that's one of the tensions in this.
Yeah.
And then the cost per foot is also, there's a tension in that. And so you get to a number, and then you're in Disneyland kind of numbers all of a sudden. So then all of a sudden it's like, how does this work at this price per foot, right?
Yeah.
Because the replacement values and the cost and the rents, that grows. But you know what? Do some tenant improvements nowadays. And so we have a package of 3 beautiful buildings that we're coming out with soon. And in that portfolio, asking rents have been 12 and 6. Their achieved rents are less. But then with all the tenant improvements that got added in and then amortized into the deal, so rents kind of get there. And so, but I would tell you that when there's a lot of TIs, the amortization of those TIs is taken out.
Yeah.
I mean, they figured out that that's not rent, right?
Yep.
Those are TI amortizations. So the 3% works at the rent portion of it. Maybe not as always, probably not always on the.
That makes
sense.
But at this low vacancy rate, tenants who are renewing don't have many options.
Well, that's just it. Where
That's
they
right?
can go.
And so we're going to say,
right.
yeah, go look at the market, check it out. If you can find a cheaper deal, factor in moving costs, the hassle, everything else, tenants are paying up to renew.
I would agree.
Renewals
they
are
don't want
achieving
to vacate.
north of 12 and 6 today.
Yeah.
And the new deals we're not seeing quite as active in.
I would agree.
World,
Obviously, yeah. The cost of moving is
Yeah.
incredible.
And we don't have the spec construction. I mean, I don't want spec construction. It's better for Bart's and I not to have a
That is a
bunch
good.
of vacant
That's
buildings.
a great segue.
I think it's coming.
To our
But,
There's
next
more spec
section.
coming.
Brent,
Yeah.
talk a little bit about that. Are you still bullish on new development? I know you work on a number of greenfield sites.
Yep.
Talk a little bit about that and what the activity has been on new construction. Is when you're talking about rates rising and limited options, we got to have some additional supply.
Well, like you said
come online.
at the opening, the spec numbers are down a little bit.
What was that?
Spec development is down a little bit right now. And everyone's pausing because of COVID. But if you look at the spec projects that are out there, they're all doing pretty well. I mean, Skinnell up in Brooklyn Park, I bet they wish they had another building up right now. I mean, WPT over in Egan, they're going to knock it out of the park. United Properties down in Shakopee's got a lot of action. Opus has done very well. And I think, just in talking to Skinnell last week, I think Tim Elam said they've got 7 land sites. And they're probably going to go spec on 5 or 6 of them next year. So they're very bullish. I think United Properties will go spec on a building up in Brooklyn Park. Skinnell, I don't know if Duke will go out at Park 81, but I think there's enough demand out there for the larger users for these developers to pull the trigger.
Sure.
Well, and the taxes are so low for the first year or so. So I mean, they can the tenants can afford to pay the higher rents, because if you look at it over a 7-year or even a 10-year run, you know, that first 18 months of taxes, it's huge. You know, it's $1.50 or $2 on, you know, a couple 100,000 square feet.
Sure.
It's a big savings.
Have you added all that up? How many square feet was that?
Of new development?
Yeah,
I don't-
the spec stuff. I mean, that adds up to a lot of space right there.
Oh yeah, it'll be close to 2 million square feet.
Yeah.
Yeah,
But if they're not in the ground yet,
they'll be in the
Yeah.
ground in the spring. You're right.
yeah,
Yeah.
it's going to be winter. You know, they're not going to do winter construction,
No.
Right.
right? So
No.
they'll come online in the
October,
fourth-
November.
Yeah,
Yep.
fourth quarter.
And most of that will be office warehouse, 28-foot clear, 32-foot clear.
I think 28 is kind of the darling right now. I mean, 32 obviously from a national standpoint and from an investor standpoint, but I think we've learned that most tenants can live with 28-foot clear in this market.
That seems to be that the clear height, at least in the Twin Cities, is largely driven by capital versus tenants' needs.
Yeah. No, I would agree.
You know, to your comment before, Mark, the 24-foot clear is
Still
a
solid.
great product here in the Twin Cities. It still does very, very well.
But it's tenant specific. So
Yeah.
we'll see those buildings built, probably 10-year lease goes in it, and then that's how it works, right? You know, so that they'll
Yep.
say, that's all I need, so, okay, we'll build you a 24, and then most of the time that happens, the developer builder is already thinking about their exit at that
Yeah.
moment.
I would say that I don't think all those buildings get built on spec that I just rattled off. There's so many build-to-suits out there that some of those sites will just get eaten up by the build-to-suit and it won't be a spec project. They'll still get built and there'll still be some, you know, absorption. But there's 8 to 10 just quality build-to-suits that I think are real deals running around the market right now.
But I think we got to touch on the fact that these developers today are not going to do what the developers 10 years ago would do, is take risk on flex space. You know, the AMBs, the MBYs of the world, and well, John Allen and Gary Holmes, he built spec, and then the small bay office warehouse. You know, the 6,000 square foot small bay office warehouse.
Too expensive.
It's too expensive, there's no land sites, and there's really not a good exit for it. So that product, which is leased up, and there'll always be a demand in this market for that product type, we're just not going to see that on spec construction, which I find, you know, interesting, because the developer model has changed and they're all building to the exit.
Do you think it's kind of just a disconnect with our market where we see rates largely flat the last 10, 20 years, and we can't get to the point where we say, hey, we'll build this office warehouse building, we'll do 10,000 square foot bays, but we need a $10 rate to make sense of it? Is it just kind of a disconnect that, hey, it looks like there would be demand because all those properties stay pretty well leased throughout the ebbs and flows of the market? I mean, is anybody going to take that risk to kind of jump off and do that, be the pioneer in that world?
Are they going to own it long term? I mean, if they're going to own it long term, that might make sense. I don't think they'd build it to exit with that strategy.
Yeah.
Yeah,
But there are buyers for it. I mean, there's a lot of buyers for it.
for sure.
You know,
Yeah, it makes sense. It's a product type that I'd love to build. You know, it's just finding the land site. But if you're not building to flip in 3 years and based on an IRR, if you're holding it for cash flow and a long-term hold, that's a great product.
That makes sense.
In this market.
Sure. Let's talk a little bit about flex. A couple of you guys own a lot of flex here in the Twin Cities. It does, you know, fairly well. We've got a lot of different factors going on here with COVID and companies downtown having to deal with some of those guidelines from the CDC, also some social unrest issues here. Are we seeing a little bit of an exodus from major metropolitan centers towards the single-story flex or office users? Can you talk a little bit about that and what you guys are experiencing on your flex deals?
Yeah, I can mention that. You know, we're not seeing that. We're not seeing Class B, you know, everyone vacate those buildings and come to the flex market. But I wish they would. And it's great product. I mean, flex it's a different product today than it was 10 years ago because people are ripping out the carpet, polishing the concrete, ripping out the ceiling, spraying the deck, and people love it. And they can drive right up to it. And they don't have elevators to worry about. They don't have common corridors. There's no, you know, rentable, usable space. So the flex buildings, we have this Baker technology that we renamed Baker Tech. my business partner, Jason Simic, and Kelly Vingy really deserve the credit for this product. They turned it around. We bought it at 65% occupied within a year. We had it 100% leased. And
Lots of free rent or what?
no free rent. We don't do that anymore. And as John Allen would say, I worked for him 30 years ago. He said, real estate's not hard. It's just doing the simple things right. Clean up the vacancies. We added wonderful outdoor seating, which, in this state, people want to get out in the summer, especially with COVID. That was well received. We added a bike sharing program. A tenant in our portfolio said, sure, I'll house the bikes. And we paid for them, and our tenants, there's no charge. They come and sign them out and go on the bike trails. That was wonderful. We instituted food trucks. Again, simple things right. Just food trucks twice a week. The tenants love it. We attracted great, diverse tenants, secondhand hounds. Then we landed Boom Island Brewery, which is great because they've got a conference room. They call it Conference Room B in the brewery. And so a lot of the tenants in the park, we got 5 buildings in the park, they'll go, I got to go take this call at Conference Room B because it won't work in my office. And so they go, Boom Island, have a beer, and it's a kind of a place within itself. So Baker Tech's been successful, and I think we've got River Road, River Tech. We renamed that River Tech, and it's having the same success. So good product. Bart, I'm sure
I think a lot of it too. We found that that Flex product was really costly to turn over because we were heavily built out. So what Peter's talking about with making it more of an industrial feel, giving it more residual value with concrete floors and exposed ceilings, you're not constantly changing out how the space is going to interact with the next group. And so I think that if we can figure that out, which it seems that we've done, or we're getting there, we can still drive the rents there, but we can try to reduce our costs on that turnover. And so Flex product, if we do get this wave of downtown folks to the suburbs for that, will be really successful.
Yeah, I think it's been an interesting evolution in the industrial world is overcoming the stigma of just being kind of the redheaded stepchild, just being kind of the ugly big box. All you need to know is clear height, dock doors, and drive-ins. It's becoming more of a home to some of these companies, and I'm sure there's a level of density that you need. For example, Baker Tech is 250,000 square feet, 5 different buildings. The Hyde development with the Northern Stacks, they did a wonderful job doing the same type of deal where they branded the park. They have all these amenities. They have 1.1 million square feet there. They had enough mass to justify some of those amenities. So I think that's a pretty.
When you amenitize that high finished, which started as industrial, and it really turns into office, right? I mean, it's really
it's single-story
office space, but it started its life as a building, as an industrial building. But when you amenitize it, suddenly you're competing with all the others. And we have a client right now that has a large single-story industrial building that's turned into be an office building, and the tenant in that building wanted to be in that building because they wanted different entrances so that they could protect their employees from interacting. So they have different pods within their space that become safe areas. And if one pod has a COVID experience, then that area can be closed down and cleaned, and it doesn't cause them to have all of their employees have to go home the next day. And so optionality in their employment, hoteling, and how they're doing that is very important. And it's in an area that has a lot of amenities. And so here's the big question that I don't know the answer to is the institutional money going to pay that cap rate? Now, we're starting to see a migration from that office investment group that likes that product type moving into more of that 2-story walk-up and other things and saying, here's where it's headed. We want to go there with some of this older suburban 2-story walk-up office, some of the single-story industrial that is parked. Again, you got to be able to park it. That's the other thing that, and so, and then here it is, the ceiling of cost per foot. Where does the comfort end? At what number does an investor say, I'm out, I can't pay that much per foot?
What is it, 140, 150 on a flex?
Oh, no, it's way more than that. Yeah. You're smart. You can't see us laughing at me. All right, yeah. I bought that one, Brent.
But the tax and CAM, I mean, versus Class B office, you know, that your taxes are going to be, tax and cam would be $12, $14.
Yep.
In flex, it's $6. So you got that delta
No
that you
question.
can put to
And the
towards-
tenant can clean it themselves, and the tenant can kind of do some of their own things that, you know, these single tenant buildings or the owner of them can do that as a portfolio. So I think it's going to be, and these guys own a lot of it, and so they're going to run it well. We're going to be watching how they do it, and then others will copy it and say, let's do it like that.
I would still say that flex is the slowest product type right now.
Yeah.
It's the biggest question mark as to how people will return to work.
Yep.
So, I mean, people are just delaying their flex requirements right now. But I think there will always be a need for it in Minneapolis. We got a strong, you know, med tech sector. So, I mean, the single-story office can obviously be converted to clean room and things like that, which Minneapolis is just dominates. You know, Plymouth, Eden Prairie, the West Side especially from a flex market, which is why Baker Tech is doing so well. But to Peter's comment about amenities, I think, you know, not just flex buildings are going there. I think office, warehouse, and even bulk buildings need to start having some amenities. Northern Stacks obviously did it with the brewery and the walking trails and things like that. And you know, United Properties is probably going to do it up in Brooklyn Park with some common areas. You know, they're talking about it. Was it a basketball court? Is it a pickleball court? Is it just a bocce ball area with some covered areas for company meetings outside and things like that? I think that's the next wave. It's not just a box. And even if it doesn't get used, it's just the management can check the box and say, we give this or we offer this to our employees. You know, because at every office building, obviously it's got the gym and the cafe and the bar and everything like that. And it shouldn't be just dedicated to the office folks.
Yeah.
So I think that's going to be a differentiator here moving forward on
Are you saying they're going to convert ping pong tables to being cornhole games? Is that what you're saying?
Yes.
'Cause that was the whole thing in the office market, right? Ping pong, ping pong.
And again, they might not ever get used.
Yeah.
But
Yeah.
it might
to have
differentiate
it.
yourself, and the tenant might just say, okay,
Yeah.
let's go try this.
It's just
Yep.
the knowledge that it's there,
Yeah.
and just to kind of build a sense of place.
For sure.
We're definitely taking a little page out of the office playbook, I think.
Yeah,
And I
not
think
to the
it'll
same
benefit
extent, but yes, yeah, a little
over
bit.
long term.
Yep.
Sure. How about infill and I guess outfill locations? Before COVID, everybody was talking infill. We need to get closer to the core. We need more distribution centers closer to the core, being close to labor. I mean, is that still the trend to kind of get close to the downtown core, or some of the tertiary markets? Are they booming right now?
I'll take it right away. I'll start. I mean, I still think overall, I mean, the trend is going to be close. I mean, it might not be in Minneapolis anymore. We got a lot of people that are saying, you know, I don't want to be in Minneapolis because of whatever social unrest, leadership, whatever it might be. But I think we forget about the outstate market. I mean, you look at, I just ran through some deals here. There's about 1.2 million or 1.3 million of new development that happened outstate here in the last year. White Claw, the seltzer builder or beverage, built 600,000 square feet in St. Cloud for White Claws. Delta Modtech built almost 200,000 square feet in Ramsey. Bosch is building 265 down in Owatonna. Tuffy's Pet Food, almost 200,000 feet out in Delano. These are big deals that we don't always talk about. So everyone always says, let's get infill. But then you got, 1.5 million square feet of big buildings, in third tier, tertiary markets.
Yeah.
So that's something we should talk about or think about. But yes, I mean, as an overall, I think people still try to, be closer in. I mean, it's evident by Rogers. I mean, Rogers is still an island. I mean, Brooklyn Park and Maple Grove, they'll pay $5.50 a foot. Rogers, it's a $1.50 a foot cheaper. People just don't go there. So I think people are putting their money where their mouth is, and they are going in more infill.
Yeah. Yeah.
We had success with our our Midway portfolio we purchased. 1.8 million square feet, 88% occupied. Certainly great demand. All we had to do was clean up the vacancies. We repainted, rebranded the portfolio, and did all the new parking lots, did new levelers, new docks, cleaned, white boxed the vacancies, and have a great leasing team, Eric Batiza and Brian Doyle and his team, and they did a wonderful job, and we're at like 96%.
But I think tenants need to see it. You got some owners that just say, well, can't they envision it? It's like, well, no, they can't. They don't do it every day. They're running their business. They take the path of least resistance. If they're on tour, they're going to go look at 5 or 6 buildings. They're going to remember the one that looked nice, and they're going to overthink the one that was not nice so that they had to renovate. So, I mean, John Allen was the best at it. As soon as the tenant left, he ripped up the carpet, and everything was beautifully painted white, and very successful. And I think everyone else is following suit, and the people that aren't, they're sitting on vacancies a lot longer.
Yeah, and that's the benefit of having the broker open houses, too. All the brokers get to come, they see it, they see what we've done, they hear the story, they got to believe in it, and they'll help sell it.
Yep.
From our portfolio, I'd say that the activity that we're seeing is primarily or is stronger in those infill markets than those markets that are a little bit out like Rogers. Certainly, we're not seeing that. So, Midway, and that is ground zero.
Yeah, I've heard that's just continues to be on fire. Mork, I know you have a lot of product in the Midway area, and what are you pretty much 96, 97% occupied there?
Yeah, and again, right, they don't have a lot of options. The vacancy rate's low. They want to be in the Midway. They get great freeway access. It's good labor pool. It's just got to be, well maintained, taken care of, professionally managed, and lease.
Yeah. How about outdoor storage? I want to say I get at least 2 to 3 calls a week for outdoor storage. I know there's a lot of requirements coming out that need outdoor storage. It's an absolute
gold. If you've got
it's a
trailer
black
parking or
hole.
outdoor
You
storage.
can't find it.
Yeah, especially again infill. If you obviously if you want to go to Princeton or wherever, you can go up there and find it. But if you're going to be in Golden Valley or Egan or Roseville, if you got outdoor storage or trailer parking, it's like gold. So developers when they're building, I think they're learning this. Obviously, they're building bigger truck courts. And doing whatever they can to accommodate the parking or the outdoor storage because it's in such demand right now.
And you can charge for that?
You can charge, you can charge,
Buck?
yeah. I mean, in some cases even more. If it's paved and fenced and lit, you're $1.50 a foot for outdoor storage.
Yeah.
Or per trailer, on a per trailer basis, you're between $100 on the low side per month and $200 on the high side for trailer parking. Yeah.
It seems like most of the new development has trailer parking, trailer stalls, but none of them have the fenced yard space for construction materials or storing other
Hard to find.
products.
Yep.
Yeah. I think that's something that it's getting just more difficult with city regulations, and you got to go to Savage or Chaska or something like that to get that. So let's talk a little bit about construction. TIs were going out of this world. Just 10 months ago, it was $80 a foot to go build out a brand new office from Shell. Are we seeing a little compression in those pricing, or is that still just off the charts?
There's economies of scale to that one. If you're building out from Shell, so if you're building 10,000 feet, significantly different than 1,000.
Sure.
1,000 feet is going to cost you probably $100 a foot.
Yeah. But as far as general pricing for construction costs, are we seeing a pullback in that along with the economy in general?
I don't think
so either. No.
Yeah.
You guys are making this hard because, in my investment books, we've been using $25, $30 for that office build up for a while. I don't understand.
Well, I agree.
I don't even know what you're talking about. I've never, this is math I've never heard. I don't, it's not that.
Polls,
much.
but I would agree if it's existing, obviously, it's 20, 25, $30 a foot. But if you're building from scratch and you're building 4,000 square feet, it's 80, $85 a foot all day long, and you're lying to yourself if you're.
Well, and I think the
you're
investors
budgeting
have
less.
figured that out, that us investment brokers are we might underplay what it costs to build out space, but and it is interesting to hear you guys talk about what you're doing in some of that higher finish kind of space. Is there a reusability? Can I ask a question? I'm going to
Fire
anyway.
away. I gotta
Is there a
filter through these online
reusability on that
questions.
space? I mean, does that TI number drop then because you did that the first time, where you polished the concrete and you put the
As long as you don't put carpet over the top of it.
redo it again, right? Yeah.
So there's a lot of residual value to having the.
So there's a
concrete
reason why
polished.
that extra investment for that kind of space.
Yeah.
Oh, yeah, for sure. We just are fitting out a vacancy down on our waters project, and the contractor said, well, to put all the lights back in, it was X, and then to recarpet, and then to paint, it was like $100,000. And we said, well, what if we just rip out the ceiling, raise up the sprinkler heads, paint it, and take out the carpet, because it was neat anyways, and polish the floors, and it came in less than just putting the building, the space back together, and that's what people want. So, and I think you get a tenant that could be a higher quality tenant that wants to sign a longer term lease, that's willing to pay more for the space.
So in flex product will make more sense on the next cycle around as landlords are doing that.
But harder though in a 32 or more kind of space where that office component moves around. It isn't as often.
Yeah, but it's not a lot of office.
Yeah, you're playing with a much
But then
smaller
it's
number.
as a percentage is less. You're
Correct.
yeah. So.
Right.
Sure. How about lead times with construction? Seems like brand new construction out of the ground, would take maybe 10, 12 months from, signing a lease to going through planning, getting approvals, pre-ordering, precast. Has that been affected with supply chains being disrupted with COVID? And
We haven't seen a whole lot of that. I think we've just seen tenants way out in front of their requirements, and that's partially broker driven because they want to get in front of the tenants and wrap up the assignment or win the assignment, and then partially is like we said, we talked about the projects are getting larger, so naturally they're looking at build-to-suits, so they're looking 2 years in advance. So these deals are taking a long time. I mean, you're sitting there talking about deals on your prospect report for 18 months.
Sure. Got a couple online, or like 10 online questions here.
I'm definitely not going to tell you some of the questions that my friends have been texting.
We'll get to those in a second. Let's see here. So in general, activity in the market has been pretty strong, I would say. On a scale from 1 to 10, what would you put it at? 10 being best in terms of market activity, getting deals done.
5, 6 for me. I think that deals take a little longer. I think bigger tenants are willing to make decisions quicker than smaller tenants. I've had a couple tenants say that they want to wait for the election to be over. Can I just do a 1-year lease? Because they're just so scared about the election. And uncertainty. So in very few cases, I'm sure you and I are doing 1 or 2 year renewals. They're a tenant that we believe wants to stay in the park, but other than that, it's picking up. It's picking up.
Sure.
Yeah, I think I would echo that. 6 or 7 for me. I think obviously we shut down, and now the wheels got to start again, and there's a process to how long it takes to execute a deal. So I think we're seeing a lot of it, and we are still seeing the term on new deals. We're not really looking at much that's south of 7 years, and renewals we're trying to push for that 7+ as well. So. There is the uncertainty of some of the smaller groups that are looking for that 1-2 years, but it's a challenge for them to find it too, because there's limited product. There's not a lot of landlords that will offer it. So yeah, it's case by case. If you'll allow it, a tenant to hang out for another year.
Yeah.
So
we talked a little bit about rates earlier and just being, getting over that stigma, the 850, 450 market. Where can we expect to see rates in the next 12 to 24 months, and where are you guys pushing at?
Well, we have a healthy market, I think, and it's a dynamic Minneapolis market. So I think our expectations are that they're going north, or they're going up, and so I think we've been flat for too long. And our agenda, or my agenda, is to try to rise the rents in this market. I think that the businesses can afford them. We've got great fundamentals here, and I think that we're going to keep pushing that. So, I think you asked me a question earlier, is the floor 5 and 10? And I'd like to say, I'd like it to be higher than that. Renewals, we're certainly seeing that they're getting higher than that, and new deals are certainly there too. So, a year from now, time will tell, but I think we're north of where we were last year.
Okay.
So
there should be no more 8 and 4.
No, there should be no more 5 and 10.
No, 8 and 4. I would completely agree. Yeah, there's no question. 8 and 4 is a thing of the past.
Let's just forget about 4 altogether.
Yeah.
Well, yeah, 5 is a new 4. I think it's obviously it's market by market. Again, if you got Rogers, that's its own little market. That's its own world. But I say if you get more infill, it's hard to find anything south of 475 for good warehouse space. It just doesn't exist anymore. It just doesn't exist. And again, I think tenants, to Ryan's point, can pay it. I think there's just been a mentality that local landlords would just be nice and lower their rates. But these tenants, as a percentage of their overall cost, the rent really isn't that much.
Yeah.
So if it goes up another quarter, 30 cents, it's not going to break the bank.
Yeah. It's just your job to educate them.
Thank you.
Right? That's going to be $5 warehouse
good at
rates,
that.
right? No more 4s.
Start early, yeah.
Even our Midway product, it's Class B, B- product that we certainly put a lot of money into the infrastructure, but we're not doing $4 rates there. No. They were doing $3.95 there a year ago.
Yeah, you don't have to.
You don't have to.
You don't have to.
Well, and what's interesting
Jason, hold on. Jason.
Well, some of those ops are not controllable too.
Jason's question was,
Yeah.
talk about it as a gross number. If your tax and CAM is lower, obviously you can charge higher for your net
Yeah.
rents. But if your CAM gets out of control, the tenant's not going to pay as much on the net side.
Yeah, well, you certainly want to be as efficient as possible, right? You want to keep the CAM number down, and that certainly can be controlled to an extent. I mean, when you sell a building, that tax number is going to go way up, and the tenants don't think about that when they're in the building. They got a 5-year lease, and the building trades in year 2, and then year 3, they're like, why is my tax and CAM number so much higher? Well, unfortunately, the building was assessed at $60 a foot, and it sold for $110 a foot.
Yep.
And they get upset about that, and they're paying for everything. It's triple net. That's the good and the bad about industrial real estate. The tenants pay for everything, so you have to be very conscious about how you operate the property and make it as efficient as possible, but keep those CAM numbers as low as possible. And one way we do that is on snow removal. These snow companies want to say, well, let's just do a monthly fee, and would you just pay us a monthly fee and you don't have to worry about it, we don't have to worry about it. Well, the tenant's going to have to worry about it if we don't get any snow all winter. And now they've got this CAM bill that's higher than their friends down the street. Well, we paid a monthly snow contract. That's not what we do. We do it time by time. So if you have a heavy snow year, everyone understands it. If you have a light snow year, everyone gets money back at the end of the year.
Well, we've got about 15 minutes left here. We've got a handful of online questions. I want to open it up to the floor here to see if anyone else has questions. But here's one on refrigeration. I think it's an emerging trend around the country with refrigerated distribution centers. Are we going to see that here in the Twin Cities? I know there's a handful of users like Americold that are already here. Are you guys seeing refrigerated DCs popping up?
I think there's demand for it. I mean, there's a lot of food and beverage companies out there that really want it. You don't see it built on a spec basis because it's pretty specific and it's really expensive. So it's going to be driven by a user, whether it be in an existing cold storage building and that developer goes out and builds another building, or that owner does, or it's just a build-to-suit for a food or beverage company.
We have it in our portfolio, and it's not everyone needs it. And when you have a tenant in there, you want to renew them, but if you lose it, and we almost lost this one tenant, so we were out in the market looking at it, and it was concerning because there wasn't a lot of people going, yeah, I'm going to pay $10, $12 net for cold storage because it has to be that rate because it's very expensive to operate.
And it's kind of hard in the building. I mean, that's the other
yeah.
part of it. So the building really should be built for that purpose. And so when you convert an older building to be refrigeration, it costs a lot of money. And even then, you have to still to retrofit a refrigerated space back into it. Over the years, I've sold a number of them, and it's like the restoration clauses are pretty extensive in those.
Sure. Here's another one. What are industrial developers thinking they need for an exit sale cap rate to justify new development at current all-in construction costs? Maybe, say, 100,000 square foot building, say you built it for $65, $70 a foot.
I mean, that's all they're.
That's probably pretty light.
Right? I mean, some will build it for 30 bips, some will need 100. I don't know. I mean,
Meaning
that's
that
all about-
meaning that you build it for a
Yeah.
7, build it to a 7, and you got to sell it at a 6 or whatever your risk
Yeah.
is.
Yeah.
Yeah.
Yeah. So you build it for a 7% at a 7% constant. You got to flip out of it for a 6 or 6 1/4 or whatever that might be.
It's the delta between your going in and your exit. That's the question,
Yeah.
right? And if interest rates, as Peter and I were talking about earlier, what if that change quickly?
Right.
Would that delta be inversed? I mean, it's just but so I would say that most of the time right now they're solving that number is growing because it helps their IRR, and all it takes is the magic button. You find that magic button on your computer and it works. So so a stupid pill and a magic button. That's what it is.
Pretend leasing.
So what's a spread typically at half or 50 basis points, 150 basis points? Is
30
that
to
kind of
100, 30 to, yeah.
Okay.
It's depends, that's that,
It
it
depends.
depends.
That's kind of the
Yeah,
range.
how bad do you want it?
Yeah.
And what do you really think it is, right?
Yeah.
So that's the thing.
Yeah.
Yeah.
If you have Amazon in your back pocket, I mean, you're going to build to a much smaller spread there.
Sure.
Right.
So,
And I think it's difficult to get construction financing now for spec construction. I think these lenders are pausing on that, which is another challenge for speculative construction. It's the financing.
Any other questions here? Or anyone? If Sherm Mulkerson were here, we'd have at least 2 to 3 questions. I know that for sure. Another one here. All right. All right. Oh, Steve. Yep. All right. The question is,
Do you really
Big
want to
elephant.
repeat
We're-
that question? Oh my gosh. Steve-O, I
do you
love
guys
it.
want to take it?
Sure.
I don't care.
All right. The question is, who do you think is going to be president on November 4th or January 20th, 2021? And how do you think it's going to affect the economy or affect the market?
I think it's going to be Biden, and I think it's going to negatively impact our market.
Just with the confidence in the market?
Confidence, 1031 exchanges, capital gains, just overall.
I think it's going to be Biden too. I think that it's going to negatively impact certain segments of our market and positively impact others. I think healthcare is going to do well under a Biden administration. I think other type of social services will do well. Environmental focus groups, energy will do very well because there'll be a lot of dollars flowing at that. But I think industries like defense will suffer, and I just hope that they don't get aggressive on cap rate on capital gains
and 1031s.
and then 1031s. If they remove that, that'd be terrible.
Yeah. Bart?
I probably would say Biden as well, but I really don't know. I think that Trump has a very good chance of winning this election again. So, yeah, to be determined how everything is going to shake out. But
I think Trump's going to win, and I think that the 1031 and the capital gains, all of that, regardless of who wins, is going to change. And someone's going to have to pay the bill for what we've just spent. And I also think that it's important for NAIOP's really a great example. It's a good commercial for NAIOP to be a part of an organization like that helps your industry, because they're out there trying to make a difference to help the law behind it. So,
Right.
yeah.
One leg of the stool, just
Yeah.
advocating for commercial property, owners and occupiers and their interests. So, any other questions here? If we don't have any others, I think we can Connor?
probably Peter.
I'd love to buy it. I think whoever buys it, I think it's going to be someone who's not in this market yet. It's going to be new capital that really wants to come into this market, and that's a way to come into this market with a splash, is to buy a portfolio of that size. But I don't
That goes back to my first comment about what I think the market is, and it's corporate. I mean, it's larger groups coming in. And we didn't even talk about this, like on the tenant side, how many times have we seen a confidential tenant? It's Project X or Project Y, or it's like everyone is a big corporation. They want to be confidential. You got to sign an NDA.
Yeah.
I mean, this all stuff that's happening in the last 2 to 3 years. It's just we never saw this. All these confidential tenants and all these like I said, NDA. It feels like I sign an NDA every week.
Why do you think that?
I don't know. That's why I'm scratching my head. It's like I don't know why they want to remain so confidential. I don't know. I haven't found the answer to that yet.
Yeah, I agree.
But I think our business has emerged again to being that professional business, right? I mean, we have to be pros at this, And I was talking to my two partners, Peter and Peter here, and we're like talking about how do we move the ball to move forward, right? And it's about we're pros. We have to operate in a professional way, and that's one of the things, right? We can't. It's not shoot at the hip anymore, And run the process really matters. That's the other thing you guys have talked about as well through the tenant rep process, the sale process. It's become necessary to do it right.
Mark, I had a question for you. Have you heard any of your out-of-state clients be concerned about coming into Minneapolis after the rioting and defunding the police, et cetera? Is that
Very much so early on, and not so much now.
okay?
And so it really, I think they're realizing that the sensationalized media of where the trajectory of Minneapolis was worse than what it is now. And so I think they're seeing that, okay, we're going to figure this out. We're not a wild state where this is happening. So yeah, so now it's, they were like, oh, I don't know, should we be worried about Minneapolis? Now it's, we don't have enough listings to sell right now. It's so it's turned, and it's a good turn. So thank
Great.
good.
All right. Any others here? All right. Well, let's just finish up just with some forward-thinking final thoughts. How will industrial change kind of the next 5 to 10 years? I mean, we're talking about being more corporate. Will we see, higher clear heights? Will we see 36, 40-foot clear heights, more automation?
I think we'll continue to see larger companies come into the market. I think we'll see 36 and 40-foot clear on build-to-suits. I don't think we'll see it much on spec in the next 12 to 24 months, 5 to 10 years. I don't know. I think we will. We seem to lag the rest of the country where they're already doing 36 and 40. So I think, yes, in 5 to 10 years we will. I think rates will continue to go up. And I think bulk will continue to be the darling.
I'd say that the next 5 to 10 years, I worry about losing our Fortune 500 companies, quite frankly. I worry about these companies pulling out of state because of our government taxation, regulation, inability to promote new development, new growth. And if we lose those wonderful companies, we're going to lose a lot of high-tech startup companies that flow into the flex products we have. And so, I worry about that. I mean, Minnesota, right? We all love it here, but it's not the ideal climate to live in. Our 10,000 lakes are going to be frozen in 30 days for the next 5 months. So we got to make it attractive to keep business here.
Bart?
Yeah, that's a great point, Peter. But I do think we'll see growth in the future here. I bet we'll see a lot more institutional capital flooding into this market as well.
And I think that's right. I think we'll see, like I said earlier, there's so much capital trying to get here, but there's commonsensical needs to that capital, right? So it has to make sense, and the businesses have to be sustainable. And so I worry a little bit about our core downtowns. That it's better for these larger corporations to have their offices in an area where they can be in that. But I think that Minneapolis, of all markets, is well suited to have corporations not only in the downtowns. And so I think we can work through that. And yeah, I mean, I think we're going to see more and more interest in the different industrial product types because the other investment choices have risk that isn't. And so today I think we're seeing the investors that are in those are opportunists. And so we'll see more and more opportunists going into the areas that have a challenge, and an opportunist needs to have something that's broken or they can do something to turn the return, right? And so the stable, solid, investment is probably going to be the industrial.
Mm-hmm. So we'll see more office and retail type investors coming over to the industrial side, is what you're saying?
No, I don't think so. I think that the office and retail type investors are going to have to learn to be opportunist and figure out what to do to reposition their assets. We're going to see some real smart minds thinking about what to do with some of these buildings. And then on the flip of that, we'll see the larger institutions that we already have. Let's call it, maybe there's 10 of them that are the biggest. They're just going to keep getting bigger and buying each other, right? I mean, that's just what's going to happen. And so we've watched these big groups buying the REITs, so Prologis purchased, Liberty. There, all of a sudden that they did that, right? And so these big $5, $10, $20 billion deals are going to keep getting done. And so we're going to see, consolidation as well in that world.
Yeah. Great. Well, I think that's all we have for time here. Again, appreciate everybody coming out here and coming in person. This has been great to see all your shining faces. and hope we can do more of these in-person programs moving forward. So with that, let's give our panelists a round of applause.